Hello, my name is Anna, and I'm going to tell you about savings, investments, and how to create a budget. As for myself, I was a trader for many years, and I'm also teaching at university. I look forward to teaching you this course. Why saving is important and why attitude towards money is important. We have seen many lottery winners making millions literally overnight, just to understand that few years later they pretty much end up with nothing. Many football and sports stars and in the same situation. So understanding the importance of saving from an early age or whenever you want to start in life is very, very important for your well-being. So where to start? Do you want to buy a house, a car, go to a nice holiday? You need to start by opening a bank account. And then we are going to see how you can utilize it to save. You need to understand where you are in your life. Are you a high school student? Are you a professional? Are you someone who is looking for a job? What age you actually are? And based on that, you can decide how much you can save and also how to save. This is called reward and risk profile. How much risk is an individual going to take to generate some returns? Because remember, there is no free lunch. If you are going to earn money by investing in, let's say, stocks, you need to understand there is some risk associated with that. A company risk profile is different than a private person's, individual's risk profile. Company's risk profile determines the willingness of that company to take risk in their decision-making strategy. How do we measure this risk profile? We need to see, are we going to invest for next year, 5 years, 10, 20, 30, 50 years? How old are we? If we are really managing our pension, we need to be very careful not to take extra high-risk investments. What is our income? How much of our income we are going to invest? So the larger share of your income that you're going to invest, and if you are younger, you can still invest in some of equity markets. If you are in a situation where your children are grown up and you actually want stable income and pension, you need to actually take different decisions towards investments. Also, do you have dependents? Do you have a family? Do you have children who are going to school? Do you need to support them? These are measurable aspects of your investment. Also, there are some less quantifiable measures that are linked to you and your personality. For example, are you a person who likes safety, stability, or do you like adventure? Do you like surfing or some other sports? Do you have attitude to risk which is higher or maybe lower? How do you react to hypothetical loss? Let's say if your investment loses £100, is it really going to bother you? Or you are going to think, oh, it will recover tomorrow I can make 200. And also, what are your long-term goals and long-term values? So in wealth management, we say there are three main risk profile groups. There is conservative. These are people who do not like to take risk in their decisions. Moderate, and also people who have aggressive approach to risk. People who want to make more but are also happy to face more losses. You can all have a look at Standard Life's questionnaire and see how you can measure on the risk screener. Everyone needs, from high school to people in their older age, financial understanding and foundation. We all need a budget. What is the budget? It is our guideline. How much income do we make? What is our next target income? How much money we're going to spend? And this needs to be tracked very carefully. What are the saving goals? Do we need to take care of the savings? Do we want to save 20% of our income to build our investment goals? Important, as soon as you have a job and income, build your emergency fund. It's 3 to 6 months worth of living expenses, and this can go in some high yield savings account. Money can be, let's say, locked for 3 to 6 months and pay higher interest. But unexpected costs can be covered from this emergency funding if you need them. And we all get into different emergency situations in our life, and we all appreciate having some income and some money that we saved somewhere. You will also learn to understand investment accounts. You will understand the tax advantages of different accounts. In the UK, we have individual saving accounts, ISAs. We have cash ISAs, saving accounts where its interest is tax-free, and it's for investors who prefer lower risk and they want liquidity. Liquidity means you can cash your investments usually within 24 hours. Let's say if you invested in shares or bonds and you need to pay for something, you can sell your investment and actually get cash. It's called liquidity. You can also invest in stocks and shares ISAs. This allows you to invest in stocks, bonds, and funds without capital gains or income on profits. There is also Lifetime ISA designed for saving for a first home. You can contribute $4,000 a year and the government adds a bonus of 25% or $1,000 annually. And it's well worth it exploring these opportunities that are always coming with the different budgets that governments create and making most out of it. Consider pension plan as soon as possible. You can have workplace pension, you join your employer's pension scheme, or contributions can come from you and your employer, where actually some employers are matching these contributions. Personal pension plans. You consider setting personal pension if you want additional retirement savings. Contributions may receive tax relief. Young investors. We believe that financial literacy should be taught from high schools or even earlier. It is very important to start investing early. You choose your investment strategy. And this is fascinating because everyone should know that everyone with the right savings attitude can be a millionaire. And we will show you the spreadsheet and you can calculate if you save, let's say, £10 or £20 a day. If you assume in the long term that your annual rate of return is, let's say, 7%, how many years would it take you to become a millionaire if you're consistent with your savings plan? And this is not something that happens only to people from certain professions. Everyone can be a millionaire as long as you have your budget, your saving policy, you have your personal discipline, and you have clear goals and targets. So investing early is the most important. But you can start at any point, at any stage in your life. It's always wise. You will choose your investment strategy. You will see how much risk you want to take. What is your appetite to risk? You will assess your comfort zone. Younger investors usually can afford slightly higher risk because they simply have more time, longer career span. So if equity markets falls, let's say 20% in 1 year, they have many years to recover that. Investment style can be long-term growth, and this focuses on assets such as equities. You can choose major markets such as UK, Europe, United States, or you can also invest in some growing markets if you want higher return, but this will be associated with higher level of risk. So-called dollar cost averaging. Invest fixed amount regularly to reduce the impact of market volatility, and consistency is very important. Diversify your investments. Don't put all your eggs in one basket, because if one breaks, many can break. So you need to invest in different assets to have so-called diversified portfolio, to include stocks. Stocks is an investment in individual companies or exchange-traded funds, and this provides you with exposure to stock market. Bonds. Governments issue bonds when they need to borrow money from public, and you can invest in government bonds. Bonds of major Western governments are usually perceived to be risk-free, meaning that governments probably will not default on their promise to pay back. However, they still carry inflation risk, and we are going to learn about it later in the course. Real estate, and finally, cash. Real estate is a real asset, and it is considered to be inflation-proof. You can invest by buying a house, or you can invest in REIT, Real Estate Investment Trust, for exposure to property without thinking, oh, do I need to take care of plumbing or refurbishment or any other issue with the house? So you can have exposure to property market without even buying a house. Cash You can keep portion in cash or cash equivalent for liquidity and safety, but something to keep in mind is the biggest destructive power for your cash account is inflation. Inflation reached even 10% 2 years ago, which is unusually high due to post-COVID environment and supply chain problem of labor shortages, food prices spiking, unstable political situation in Europe and abroad. So inflation destroys purchasing power of your savings. So you need to be careful if you keep cash in the long run, because the amount can look good, but you can buy less goods for that same amount. You can use investment platforms. There are different investment platforms. There is Hargreaves Lansdown, AJ Bell, and others, online brokers. There are also robo-advisors, platforms like Nutmeg, Fidelity, and others. They provide automated, diversified investment tailored to your risk profile and your goals. It's important to understand the cost of investing. When you invest through the platform, you are going to be charged a platform fee. When you buy and sell stocks, most of the time you need to pay a fee associated with the transaction. When you save money with a bank is usually paying you interest on your saving account, and you need to check how much interest you are going to receive. You can shop around and find the best deals. Taxes. Some of the investments are subject to tax rate, including capital gains tax, dividend tax, and you can see how ISAs in the UK can mitigate tax like that. Something important is stay informed and educated. Follow market news. On our platform, we'll be updating you with changes in the markets, in inflation, in interest rates. Consider online courses, further courses. Join investment groups, communities, exchange views and ideas. Remember not to follow the herd. Don't invest just because everyone else does. Understand where you are putting your money and where your saving is positioned. Monitor your investment. You need to review your investment. Understand why you invested. Do you still like that particular market? Do you still think that UK or US equities are going to perform well? Is this an election year in the US? How have equity markets been performing during US elections? So you can stay educated, and I can tell you this is also fun. Understanding the markets, understanding your macro environment, understanding interest rates, policymakers' decisions is definitely something that everyone should have access to and understanding. Rebalance your investment. If you think you made enough money on some of the investments, of course you can reduce a position or you can completely sell. It's called taking profit, and you can reinvest that profit somewhere else. Always account for the risks, for unexpected. Think about emergency budget that we discussed, that is always needed and appreciated. But when you invest in volatility, be prepared that markets go up and down. Your investment will make and lose money. In the long term, it's always wise to invest, but there are also market downturns. Consider insurance. When you do get a job, consider income protection to make sure you are safe and protected against some unforeseen circumstances that can affect your financial situation. Goals, objectives, short, long-term goals. Define your financial goals clearly. Are you buying a home? Are you saving for that home? Are you planning for your retirement? Or maybe travel, have fun? Be disciplined, stay disciplined. Stick to your investment plan, even during market changes and personal financial changes. So for people in the UK, including the youngsters in high schools, investing early and wisely can enhance financial security and wealth accumulation over time. By understanding available investment opportunities, you need to set clear financial goals and maintain your discipline, and you can actually build a solid investment portfolio. If you have questions about anything, ask, send questions, communicate, and have your investment community. So this is the end of the first lecture, and thank you for your attention and good luck with your first budget.